So what we're gonna do is I'm gonna start off with a long short, and then at the end of the long short, I'm gonna unwind that and still be left with bunch of long positions that are super concentrated. I'm gonna move all those concentrated positions now into an exchange fund to get me instant diversification. And then at the end of 7 years, I'm gonna move that exchange fund into a CRUT.
No, it works.
And
It's like
that's
Russian
amazing.
dolls.
Okay.
It's Russian dolls, right? I
Yeah.
mean, like this thing just like you can imagine just like unpacking this thing and you're just like, wait, these are just stocks, right? Should I have just paid the tax?
I could have just paid the tax and move on with my life. The complexity, the fees, the potential lockup periods, the access and control over time. Hey, Brent, how's it going?
Good, good, Andre. Happy to be here. How's everything going with you?
Everything's good. It was good seeing you in person for the first time this week.
Yeah, that was terrific.
I was a little disappointed by your choice of breakfast. We were at this cafe. I ordered the avocado toast. I thought we were gonna have a thing where we both have avocado toast, and then you went with the pancakes, so it threw me off a little bit. If I'm being honest.
I have a sweet tooth, so I took the opportunity to just go all in on sugar.
All right, I'll let it slide this time, but maybe next time pair up. We got to keep the brand going. Come on. Another thing I wanted to chat about is this morning I went to a very exclusive executives club called Costco, where I lined up at 9 a.m. and there was a bouncer and they kicked 50% of the line out because they weren't executive members like me. I was able to get first dibs of the avocados today. So that was my morning experience going to my exclusive executives club, getting first pick of the avocados. For reference, the two country of origins that were available in the San Francisco Costco were Peruvian avocados and California avocados. I went with the Del Rey from California. I don't know. It felt weird buying Peruvian avocados when there's just California avocados sitting right there at the same exact price. A good $7.99 for the 5 pack.
Do you notice a price differential across regions? If so, the fact that Mexico is gone, is that kind of impacting other prices? In other words, is it pushing it up because supply is reduced or something?
I'm not sure. I was looking at the Haas Avocado Board website like I normally do every Thursday. And right now is the tail end of the California and Peruvian avocado seasons. So maybe there's just like an influx of those two countries' exports, or I guess California and then Peru exports. I'm guessing there's like more countries competing, so the prices come down. This is like a seasonal high volume wise. If I was looking at the projections, another random fun fact: do you know when peak avocado imports happen?
My intuition is skewed by the fact that I looked it up. So it's, I believe it's leading into the Super Bowl. Is that right?
Yep, exactly right. The Super Bowl happens is peak avocado consumption because everyone's making guacamole.
Okay, that's delightful.
Okay, I think we've consumed our avocado time. So today I'm excited. We were having this conversation over breakfast and we were talking a little bit around when you have a super concentrated stock position, like what are the options? Before we dive in,
Yeah, I always like to do this voiceover, which is none of this of what we're going to talk about today is investment advice. It's also not tax or legal advice. So we are going to talk about technical stuff here, but it has nothing to do with you. And this is not guidance specific for anyone who might be listening here. Please reach out to a credentialed professional if you do have some of these concerns. Just realize that we are independent analysts who are just looking at this thing closely, but this is not meant to guide your particular circumstances.
remember this is the not advice podcast. With that, I think one of the things that we were talking about was like setting up a specific scenario. And I was trying to draw a lot of parallels with a situation that I actually find myself in. So that would allow me to accurately represent a very advanced do-it-yourselfer who's actually weighing the options for how to deal with the concentrated position because I'm actually personally going through this. So let me set the stage a little bit with our scenario. This is a fictional scenario that's made up, but to model after real world scenario. We're talking about a high net worth tech employee whose total net worth right now is sitting around $10 million. 70% of that is in a taxable account. So we're talking about $7 million. Overall, their portfolio is diversified across everything. They have a very standard low fee index funds, 55% equities, 30% international, 15% bonds, like very boring bogglehead. Other than this 10% of their overall net worth is one single position in the company that they work at currently. So we're going to be looking at the scenario from that lens where they have $1 million in their taxable account. That's all in a single concentrated position, and they're currently working at that same company. So that will help constrain us a little bit. To add a little bit more detail in the scenario that will help us play around with it. Let's assume they have $500,000 in cash that they're waiting to deploy. They're in California and they're in the 37% federal tax bracket, just to give us a sense of like where they're sitting. And at the California tax bracket, that will probably put them in around the 10.3 to 11.3% range. But again, we're not going to go that in the weeds, but just to set the context of how you're thinking about it and how we're thinking through the potential. And one last piece on the $1 million concentrated position, which is the biggest conversation piece here. Let's assume that the cost basis is $300,000. What that means is of that $1 million position, $700,000 is unrealized gains. Let's make it easy and let's assume all of that is long-term capital gains. Does that sound like a good setup for the initial scenario? Any specifics that you wanted to clarify, Brent?
No, I was just thinking, this feels like an interview question. So I'm just like, okay, I've got all the pieces. I feel like, are there any clarifying questions that I want to ask? So I'll just riff on a couple of these just to regurgitate them back to you. There are 4 strategies that come to mind that seem applicable in these circumstances. There are more, but let's keep it simple at first. The first one is just selling some stuff, and you want to sell it in the order that makes the most sense. Then there's more advanced strategies, the tax aware, long short. We can employ leverage to get some additional benefit. And then there are strategies where we're not going to sell anything. That could be an exchange fund, or in our case, we'll limit our charitable strategies to the charitable remainder unit trust. So those are the 4 things that come to mind. There are more strategies, but the 4 things: selling, tax aware, long short, exchange fund, and CRUT. The reason, if I heard you correctly, the person is still they're still employed by this company. Yeah. Okay.
They're still employed at that company. What does that rule off the table if they're still working there?
It means we can't use options, and you also can't sell short. That doesn't make sense in this particular circumstance, but just suffice it to say, you usually can't hedge. But there are other things we can talk about. So today we will not talk about options or variable prepaid forwards, even though both are bona fide strategies in the right circumstances. In this case, again, selling, tax aware, long short, exchange funds, CRUTs.
My experience in companies, they all have had policies around preventing you from trading options or leverage against the company stock while you're currently employed there.
If we think about selling, there are other corporate limitations too. Andre, you've mentioned this in the past. We've got the concept of blackout windows or defined trade windows. If you're considering a selling strategy, just one of the extra concerns for a corporate employee is, are you doing this at the right time? I think the consequences of that are dire. Make sure if you're doing any of this stuff yourself that you've always just checked the box on trade window or trade approval, anything that you need to do on the corporate side. Just check all that stuff before you execute.
So where would we start? Was it like going through just selling the position? That's where I always like to mentally start, where there's a tendency to want to do the most complicated thing. And it's really fun to talk about these complicated topics. But the first place to start normally is, what if you just sell the position and pay the taxes?
Yeah, I think that's right. The things that immediately come to mind when I think about liquidating the position. So first, liquidating the position, just selling it all in the current year, that is generally, in my mind, the benchmark for success when we're considering other strategies. So other strategies have to outperform the person selling right away, realizing all the tax, and reinvesting. The other strategies have to like come over that as a benchmark for them to be even worth considering. So the first thing that I think about when I think about liquidating a giant position is investor circumstance type stuff. In other words, do you have a big bonus this year? Does your spouse have a big bonus this year? Are you already at the marginal rate? In which case, you should just be extra sensitive to the taxation that you're going to essentially get hit in the face with when you realize all those gains. And then after that, let's assume that you want to be really deliberate about the way that you're unwinding this position. So then what you want to do is look at the individual tax lots that compose the position. And you made the simplifying assumption, thankfully, that all of the tax lots are long-term. So you've held them for specifically greater than 1 year. It would get slightly more complicated if we had some short-term lots in there. But the idea is generally look at the individual tax lots and find the ones with the highest cost basis. And the cost basis, if these were RSUs, those would be shares that were not the grant price, they would be the vest price. So you want to choose the ones with the highest vest price to liquidate first, all else equal, the exact same shares, and that would minimize the tax impact from selling some of those shares.
Definitely. It's also a good point too. I think people think very binary, where it's either I sell everything or I sell nothing. And the nuance around looking at the individual tax implications on a per lot basis is really important. And I always go back to one of the metrics I like to look at is like, what is the tax impact per share of selling any specific lot? For example, if you have a lot that's very near the current stock price, like it was vested, like the RSU price and the current price is the same, then the tax implications are likely to be much smaller. So you might be able to go through your lots and identify some where the actual tax impact isn't going to be as high, so you don't need to think about the tax piece as much. And if there's a scenario where you have any losses, that's more rare right now at the current moment for many companies, but not unheard of. Not all companies are at all-time highs, and a lot of them have had very big ups and downs over the last 5 years, where it's very possible to have some of your lots with losses where you're able to just sell those, and those losses wouldn't have any tax impact. And then you're able to do something called tax loss harvesting, where you're using those losses to offset other gains in your portfolio. So that's where I would start. Let's assume right now for this case that there's no losses. Like it's all the 700K is all gains. There's no losses at the lots. It's all long-term. So thinking about like if we sell everything scenario, I calculated that's around like a 37% marginal capital gains tax rate, where we're at 20% federal long-term plus 3.8% in IIT, and then another 13% at the California level. That's at the high end. So that would be around 260K in taxes of just being done with it and then moving on with your life and diversifying and then being in a position where you're not having to think about this. So that's always the benchmark of what we're going to be comparing all other options to, where you're instantaneously able to sell and diversify. You do have that 260K tax hit where you're going to have to pay those taxes in the next year when you file your taxes, but you're done. And that's it. So the benchmark is now established. That's what we're going to compare all other options to. Is there anything else there? Should we talk a little bit about tax loss harvesting and what that is to begin with? Because I think some of the other strategies we're going to talk about do leverage that a little bit.
A couple things just really quickly. So let's suppose maybe you had losses somewhere on your household balance sheet. And if you did, from previous years, those maybe be carry forward from a previous transaction. Maybe you lost big on some angel investment or whatever, and you just have like essentially a tax asset that is waiting to get deployed. Then that would change like how rapidly, or it would change the net capital gains circumstance that you would experience once you're unwinding this concentrated position. I'm going to assume we have no carry forward losses on the balance sheet already. So one thing that happens is we also want to consider the time of year that we'd be processing this transaction. And like Andre said earlier, you've got the opportunity to sell a little bit over time. It depends what your risk sensitivity is. And do you have a bullish perspective on this thing? What's the overall portfolio fit? But let's say that you're selling a little bit over time. And let's assume we can move this around, but let's assume that we're talking about January. Okay, this is interesting because if you process a sale in January, you can take the proceeds from that sale and you can put them into a pretty simple strategy that will do tax loss harvesting for you. So before I go any further, Andre, give us the rundown on tax loss harvesting, and I'll tell you how this strategy works. Stage selling, very plain vanilla, before we get into it.
Yeah, so just a primer real quick. Tax loss harvesting is in a taxable account where you sell a stock for a loss using those losses to then offset other gains in your portfolio. So the key thing to remember is tax loss harvesting can reduce your taxes by using your stock losses to first offset your gains. And then if you have more losses than you have gains to offset, it can then reduce your ordinary income by up to $3,000 per year. And if you have even more losses than you have gains, and after that $3,000, it then carries forward into future years. That's a high level view. The important caveat there is it's not really a free lunch. The important thing to remember is when you're selling a stock for a loss, we're in a different scenario where we're talking about a concentrated position where you're trying to diversify. Let's assume like a normal tax loss harvesting strategy, you're already in an index fund and it has a loss and you're wanting to sell that and buy a very similar fund that's not identical, because if you buy an identical one, then you'll have a wash sale, which is, we can go into another time. I think there's a lot of posts on tax loss harvesting broadly, but let's assume that's not the case here. So you're buying a similar one, staying in the position. But remember, when you're selling that loss, you're now buying back a similar stock at that same diversification at a lower cost basis. So when you do eventually sell that new position, the amount of gains that you're going to have are going to be similar to what you just sold off, you harvested. So think about tax loss harvesting overall more as a tax deferral strategy and not this fully magical thing where the taxes get deleted, which I think a lot of people like to pretend that happens, but it's very important to remember it's not eliminating it unless you're planning on dying and having your heirs inherit the stock. If that's the case, then maybe it is eliminating. But for most people that plan on using these assets, whether in retirement or at any point, it's more of a tax deferral, which again, a tax deferral itself is valuable. So that's a primer on tax loss harvesting. Anything else to add on that, Brent?
No, that's it. There are maybe two fun points. One of them is if there is free lunch in investment management, taxable private wealth, it might be the interest-free loan that you get from the government via tax deferral. And then if there is any magic, it might be the step up in basis, which you alluded to, which is if you pass and your cost basis is really low, in certain states, you'll get spousal step up in basis. Your spouse would inherit your portfolio. The cost basis would essentially be reset to fair market value so that there is no longer a capital gain there. And then in other states without community property, you would have both spouses would have to pass before you get the full step up in basis. But those are the two things, the interest-free loan and the step up in basis. Those are probably the magic free lunch in tax management.
This is one of the parts of this scenario that I'm forcing in there now. It kind of models out my own portfolio. Is I personally have a direct index portfolio, which the whole reason why you would do direct indexing, it's basically instead of buying VTI, using a direct index product to buy all 3,000 underlying stocks within the US market. And it's able to then have a significant amount of opportunities to harvest losses just based on the day-to-day trading of those 3,000 plus companies. The real benefit is in the first couple of years, as well as that January piece that you were just talking about. Can you tell a little bit more about some of those caveats?
Yeah, we were joking earlier that so if you can think about a portfolio has cost basis attached to it. And the cost basis, I think of this as a little pile of gold, and you've got your little chisel and you're mining away at that pile of gold via tax loss harvesting. But the more that you mine, the less gold there is. It just is a finite supply. And so over time, your tax loss harvesting benefit extinguishes. And this is just an important decaying property of tax loss harvesting that investors need to keep in mind. It is not a bottomless well of tax loss harvesting opportunity. So these things behave really in a very defined prescriptive manner, but it's just a decaying benefit. That's the important thing.
And most of the benefits up front.
Yeah, definitely. If you want to use like some sexy terminology, I would call this actually like volatility harvesting. And the reason is that as the market is just like bouncing around, like your individual positions are dipping below cost basis, and those are selling opportunities to claim those tax assets. So actually, if you want to get really technical, I think about tax loss harvesting as like a put option. And so the put option increases in value as volatility increases, or two, the position dips below cost basis. So if you think about it like a put, then eventually this thing, like essentially the strike, gets so far out of the money that you just like never hit it. Eventually the value of the option goes to close to zero, not quite zero, but close to zero. So just if you're into options and stuff, a put option is a decent way to think about tax loss harvesting. Also, big caveat here, on the long side. We'll get into short stuff in just a minute, but it's not the best analogy on the short side. We can talk about that. Okay.
The target of the direct indexes that I use, it's like 14% of the initial capital will harvest in like the first year. And then over the 10 years, I think it ideally gets up to that 30% range, but most of that is front loaded in the first 5 years. So that's one strategy. But again, it's 14% of the initial capital. So in this situation right now where we're talking about, hey, I have 700K in capital gains right now, there's no way a normal direct index will help me get enough losses now to meaningfully offset it in the short term. So that brings us to our second solution.
Not yet. There's more to milk in this very simple strategy. Okay. Yeah. So if we start, let's say we're in January and we are trying to work down this really concentrated position, and we're okay doing this over a handful of years. Let's say we have a 5-year plan to get rid of this thing. What you could do is you could sell just a little bit. You're in January, let's say you sell 100,000 or 200,000. And then you take those cash proceeds, you put them into a direct indexing portfolio right away. And so by the end of January, you're already harvesting volatility. You're already harvesting tax losses. You haven't done anything fancy yet. You've sold a little bit. You've taken the cash. You put it into a direct indexing portfolio. And then we're in the same tax year right now. So that direct indexing portfolio is generating short-term capital losses. Those short-term capital losses, after netting, can be applied to the capital gains, the long-term capital gains that you've realized from the concentrated position. So we haven't even really we haven't like fully pulled this thing apart yet. You have a lot of options that are just in long only, plain vanilla strategies for getting out of this position.
Or even in the more extreme case there, let's say you sold the entire $1 million position. If we're assuming you get the average 14% of your initial capital in losses that first year, that's $140,000 of losses in year one. That's a good chunk of your tax bill. What did we say the tax bill was, like 260? You're basically like cutting it in half as one strategy there. Again, deferring those taxes into the future, but it's allowing you to defer it in a way that allows you to get out of your concentrated position right away. So that's super valuable. And then the January piece again is important because that means you have the full 12 months to slowly build up these losses. Because again, it's not going to all happen linearly. It's not going to all happen at once. It's going to be chunky based on my experience. Like most of my losses are from like March this year where there was those big crashes. It's not going to be as predictable with a normal direct index. It's all about the, like you said, volatility of the market. If you're in a volatile market after you do those contributions, the losses will accumulate faster. But on average, that 14% is what the industry says for a like typical VTI, VOO, so S&P 500 US equity direct index. If you're in January, you have that full 12 months to be able to slowly do that. And again, like Brent's saying, you can do part of your portfolio and trickle that in.
Yeah, that's exactly it. So we have a lot of flexibility just in the first year. And this is where your point on direct indexing versus, let's say, tax loss harvesting a portfolio of ETFs. This is where direct indexing is really interesting, particularly as the number of individual positions expands, is because now you're taking advantage of idiosyncratic volatility in the portfolio. Essentially, you're getting all this granularity, and these granular positions can be used for individual, very tailored tax loss harvesting. So essentially what you get when you harvest individual positions like that, very granular positions over an ETF portfolio or something, you just get that much more juice out of the tax or out of the cost basis. You're able to mine just that much more gold out of the portfolio. That's maybe the important thing is granularity of direct indexing just gives you just like extra utility. The other thing is that this is so dependent on volatility regime. So you could have just like markets are going up, volatility is minimal, just the opportunity to harvest losses is going to be smaller. But you could have complete different situation. If you had harvested a giant position right before, I don't know, Bear Stearns collapse, and then you were going into a Lehman situation in the fall, like you can imagine that the losses that you harvested would be substantial. So then those substantial losses this is the same tax year, can be applied against the concentrated position that you're unwinding. So just to make a point there, it's so dependent on overall direction of the market, idiosyncratic volatility, all those things really matter. Your results may vary or your mileage may vary.
And are we taking for granted that you're actually mirroring the index too? The portfolio drift away from the index. So all the numbers that we're doing, a lot of it assumes that even though it's composed of all those individual stocks, it's able to still mirror that underlying index that it's trying to track.
Yeah.
Yeah, I think might not always be the case.
Yeah, exactly. Yeah, tracking error is it. So like the most plain vanilla sort of implementation. Let's think about the largest S&P 500 ETFs. Tracking error is like 0 and 0.0, maybe another 0.1%. Like it's so negligible and tiny. The mandate, I believe, is like prospectus level 0. And so that's different by holding the individual positions and harvesting them and using portfolio sampling to only hold a subset of all the names in the index versus every single name in the index. You introduce risk. And the risk is that essentially the portfolio composition deviates from the underlying index. And that's called tracking error. There's a way to quantify it. It doesn't really matter for this, but suffice it to say that whoever's constructing the direct indexing portfolio is introducing an active perspective. They have a sampling methodology. That sampling methodology is active. And whether we like it or not, you can call it a passive strategy, but it is an active strategy. And the active strategy really, it might underperform at times. It might overperform. And the degree of underperformance and overperformance is essentially quantified by tracking error. But if tracking error is small, 1%, okay. I mean, it tends to be relatively small in a direct indexing mandate.
All right, so let's fast forward, go back to the scenario that we have. And this is a more sophisticated do-it-yourself investor. And they do have already some direct index, but it's been invested for a couple of years. So the amount of losses that it's harvesting has diminished. It's not going to make a meaningful dent. So let's continue to your scenario because you're talking about if you're in January and you're trying to harvest you have that full 12 months and maybe don't jump straight into some of these more advanced techniques that we're going to talk about, you could still, if you're in January and able to harvest over time, maybe that's a valuable strategy there, just doing normal tax loss harvesting or even doing direct indexing.
Yeah, exactly. Yeah, that's the starting point is let's stay with the existing portfolios. The things that you can do to really move the needle on tax losses available would be volatility of the portfolio. You could choose a more volatile expression, and then the individual, the granularity, the positions themselves.
Yeah. Okay. So what if it's not January? I think that what if you have 3 months left in the year, 4 months left in the year?
Yeah, so now we can start talking about more aggressive implementations and the intuition. So if we want to talk about long short, I think this is where this gets a lot of people's attentions. But one of the cases here is that you are right at the end of the year, you've got maybe 1 quarter left, and you would like to produce tax losses such that you can defray the impact from realizing a lot of gains on a long position. Maybe you had a business exit, maybe you're selling a property, it's closing, whatever.
Maybe your stock has drastically increased. Maybe you're at a private company with an offering of PPUs that all of a sudden you can liquidate in that year and it's all profit.
Yep. Yeah, exactly. So what are you going to do? You have some extra tools at your disposal, but the one that we'll talk about now is adding leverage to the portfolio to essentially increase the potential for tax loss harvesting. So the way that this works, this is popularly called tax-aware long short. You might have seen 130-30, 150-50, 300-200. The leverage can get really high. But the important concept is that you fund a portfolio. Let's assume cash, simplest implementation. Let's assume cash. You can certainly fund it with securities, but it depends on the nature of the securities, et cetera. But let's assume that you fund the portfolio with cash. The first thing that happens is the portfolio manager introduces margin into the account. So let's keep the numbers really simple. We'll talk about a 150-50 implementation. So you're going to introduce $100 of cash. The portfolio manager will take a margin loan for 50%. Your gross long exposure would be 100 plus 50, so 150 on the long side. That's naked exposure right now. So what these managers do is they also introduce short positions of equivalent to the margin exposure. So let's say 50% on the short side too. So your gross exposure is the 100 that you contributed plus the 50% margin loan plus the 50% in short positions. So your total gross exposure is 50 plus 100 plus 50 is 200. But you've got a portfolio. This is a 150-50 portfolio. And you're like, why would I do this? What is the point of all this baloney? So what's interesting about this is what you've done by introducing a margin loan is you've injected additional cost basis into the portfolio. What do I mean by that? When you take out a margin loan, all of those purchases, it's cash. And those cash positions have full cost basis. So let's stick with that for a minute. You have full cost basis on the margin positions. That's interesting. Why is it interesting?
What does that mean when you say full cost basis?
So it means that if I borrow $50 and I purchase securities with those $50, that the fair market value is the cost basis. And what that means, essentially, think about it again like a put option. The put option is struck at the current fair market value. So what that means is that the put option has value. It's an at-the-money option. So it has value if the portfolio has the possibility of dipping below cost basis. So essentially what it does is inject tax loss harvesting potential into the portfolio. You have that much more surface area for tax loss harvesting. That's on the long side. Now, on the short side, we have a different dynamic. It's interesting in a completely different way. But on the short side, whenever you short a position, you're betting that its value goes down. So why that's interesting is because if the market goes up, those short positions lose value. And if they lose value, you can harvest the shorts. It's a different mechanism for harvesting shorts. Just the quick and dirty on that is that you repurchase. It's called buying to cover. You cover the short and you short something else. And there's a different mechanism for short positions on tax loss harvesting. But just to give you the overall concept, we've essentially increased the surface area of the overall portfolio by grossing it up with margin and shorts. You have that much more opportunity to tax loss harvest. Let me pause there. That's a lot of words.
Yeah. So basically, if I'm understanding correctly, one, you're introducing leverage. So you're already able to harvest more on the long side. And then in addition to that, you have those short positions. So even if the market is going down, or even if the market's going up, you're still able to harvest additional losses because now your short positions have gone negative. And when I was initially like looking into this, it sounded like why can't you just offset all of your long positions with your short positions? And it seems like the IRS doesn't like that, and it forces you to introduce some kind of tilt to it. Can you explain a little bit more about like why is that and how does that work?
Yeah, the general theory is that like we want to have some kind of active placement in the portfolios. We want to have a bet that we're making so that the trades are
Right.
not.
I don't want to have the bet, but the IRS says if I can't do something just to get the losses, right? That's the spirit of it. Is that fair?
Yeah, that's it. And so what the managers do is they'll introduce like a little bit of tracking error. And this really depends on the portfolio manager. Some of them really dial and lean into tracking error. They really dial it up. And others want to hug it really close to the underlying benchmark. So it really depends on the manager. It depends on their implementation perspective, their alpha model, all this different stuff. But the important concept to remember from a gross exposure standpoint is that you've got the core collateral that you've contributed. That's the core portfolio. And then you have the two extensions. And the idea is that the extensions are market neutral. So we would say that your portfolio is beta 1 generally. So if the S&P 500 has beta 1, the idea is that your long short 150/50 portfolio is also beta 1. And that means that your portfolio is going to vary about the same as the underlying index, plus or minus, and that's quantified by tracking error. But that's the risk perspective. There's also cost associated with this. Maybe we should talk about the costs and then
Let's talk about maybe before we get to the cost, like how does this help us in this scenario that we're talking about right now? Like we talked about, if we're in the beginning of the year, maybe you can get all the losses that you need from a normal direct index. But let's say that we're only in 3 months, 4 months of the year, or half, like we don't have the full year. Like how does that help? How does long short help us there?
So just by increasing the surface area, I keep saying that, but I think it's just a helpful illustration. So by increasing the surface area, by introducing margin and introducing shorts, we've essentially exposed the portfolio to a bunch of additional volatility. What does that mean? It means that all those idiosyncratic positions, these are usually individual positions, have the chance to dip below cost basis. And when they dip below cost basis, we can harvest those losses. This is again in the core portfolio, in the long extension, and in the shorts. As long as those positions are bouncing around, we can harvest a lot more. And I think what's interesting about this is that depending on how much leverage we use, again, we're talking about 150/50, can go higher. Depending on how much leverage we use, we're just continuing to increase the surface area. We're continuing to increase loss potential. And there are two important conclusions from that. One of them is that just the order of magnitude is higher. So there are just more losses you can get out of the portfolio. There's a lot of research about this that's very interesting, but suffice it to say, of course, how much you can harvest is a function of how much leverage you employ in the portfolio. That's the first thing. It's substantially higher than direct indexing. Of ballpark
How much higher? So I think what's the direct indexing over 10 years, like 30, 40%?
30-40% on the direct indexing. If you've got the leverage like really dialed up, it's not crazy for a long short portfolio to give you 200 or 300%. And so
Of your initial capital. And with the direct index, it's called like front loaded in the first years. What's the like distribution of those losses look like on the long short side?
Yeah, it's still front loaded in the initial years. The reason for that is that there's two reasons, but the main reason is that you're still on the long side of a long short implementation. You're still mining away at the cost basis. So even though you've injected margin into the portfolio, you still have limited cost basis. So again, you've got your little chisel, you're just digging away at this pile of gold. On the short side, this is the key thing that I think people don't really appreciate on what's happening with the shorts. But on the short side, you have a different dynamic. And the way that it works with the short side is that you can think about it this way. You have unlimited downside potential on the shorts. The reason is, remember, a short is a bet that the market is going to go down, okay? But the market can go up and up, unlimited. So if you have unlimited loss potential on the shorts, you also technically, again, caveats, you technically have unlimited tax loss harvesting potential. And so in the first,
so there's so instead of like long short, or sorry, in a direct index, there's a big decay and it kind of diminishes, can go to zero. It doesn't sound like that's the case with a long short. There's a much fatter tail.
Much fatter tail. I hesitate to use the word in perpetuity just because who knows what could happen. Perhaps the market changes, but you do not have that finite supply of cost basis on the short side like you do on the long side. On the long side, you're going to get a huge pop of tax loss harvesting potential in the early years. But in the short side, it's just going to keep cranking away as long as the markets tend to go up. If the markets go sideways or they go down, different thing. That's a different thing. But since equities tend to go up, you tend to also get a stream of short-term capital losses from the short side. And by the way, they're always short-term capital losses. They're always short-term. There's no long-term on the short side.
Interesting. Okay. We were talking about like 150-50. What are I've seen a number of variations of those numbers. What does that mean? And what are like the pros and cons of awesome 150-50? It sounds direct indexing on steroids. Sweet. I want more of that. Let's go 300. What would be the 300? What's the short side on in that case? And why not just ratchet it up all the way?
There are like three things to keep in mind. So one, you're introducing tracking error. Just like the more portfolio leverage that you have, generally, the more your portfolio is going to deviate from the underlying index. That's just like the core behavior. The second thing is that portfolio expenses tend to also go up as you introduce more leverage. The intuition behind that is it takes more effort internally to manage the thing. Another thing that comes up is that you have financing costs. And this is a really nuanced thing. I'll try to just get to it really quickly. But so essentially, you have borrowing costs for margin, just like in a Schwab retail brokerage account, you can borrow. And let's say that cost is 6%. Now, the shorts are going to help defray some of that cost. That's called short rebate. And essentially what happens is you short some positions, you receive proceeds from the shorts, those proceeds go into account. The account is invested, it generates yield. The difference between those two is what you care about. So you've got the 6% on the long, and you've got maybe 5.5% on the short. So then what you actually care about from a raw cost perspective is the difference between the two. So 6% minus 5.5%, that'd be like 50 basis points of financing cost. And I think most investors who, when they're thinking about like direct indexing or just an ETF portfolio or something like that, they have not conceptualized financing cost yet. It is an incremental cost that investors are introducing just purely through expanding again the surface area.
And then that increases with the leverage.
It does, yeah. Just because you have yes is the short answer. Yeah, there's some intuition there, but yeah, yes, it gets bigger. And then the last thing is, so we talked about portfolio management fees, we talked about financing costs, we talked about tracking error, and the last thing is that you are executing, like your manager is executing this portfolio. The position sizes, one, you're executing more, and two, the position sizes are bigger. We cannot forget about transaction costs, and
there's the transaction cost, but you're also adding in. We didn't even touch on and you're forced to have an opinion, like you're having that tilt, like I've heard value tilt, growth tilt, and I'm sure there's 1,000 other different types of tilts. So you have a point of view introduced as well. So sorry to cut you off on that other one.
No, that's it. And that's usually manifest by tracking error. And tracking error can be positive, it can be negative. It just depends on how the strategy is doing. But it is a strategy. It is a very active bet, and your exposure to the manager. So the person who's actually like pulling the levers on the portfolio, it ramps up as you increase leverage. You just have, again, wider surface area. So you're just getting more exposure to the manager themselves and their stock picking ability. So transaction costs, financing costs, exposure to the manager via tracking error. And it all just adds up just really quickly.
So for recapping on like long short, the more leverage that you add, your fees increase, your financing costs, the tracking error, all things like increase. But on the pro side is you're able to harvest even more losses in an even shorter period of time. So in the example, we're saying like, hey, we have 3 months, and let's say that you only have a fixed amount of capital to invest there. Like you're able to get, what'd you say? Did you say multiples of the initial contribution in losses, which is crazy? That's over a year, I'm guessing, or something.
It's over a long time. So yeah, think about, there's a really great paper about this exact topic, which is like, how quickly can I get to 100%? So if I contribute $1, how quickly can I get to $1 in capital losses? And even with a ton of leverage, so 250, 150, we're talking about 2 years, 18 months to 2 years. So you're usually not going to get all the way there with a quarter remaining in the year. But
and in this year, what we're in our scenario, we're talking about, we have $1 million, $700,000 of it is gains. So you can do pretty meaningful amount of you could chip a lot of that off if you're trying to get less than 100% of that initial one. Plus, we were saying in the scenario, there's an extra $500,000 to put in there. So if we're putting in 1.5 million and we only need to harvest half of that, then all of a sudden that's a scenario where, hey, like the that is a interesting option to quickly accumulate losses to help offset that. Okay, that's pretty powerful.
It's powerful. The strategy or the way that I see this employed is that someone will take the concentrated position and they will use that as the contributed capital. And then the portfolio manager will introduce margin on top of that concentrated position and shorts on top of the concentrated position. And by the way, those shorts can be like really deliberately selected such that they balance the concentrated position risk also. So in other words, if you're contributing Google, you're just like, oh, when I add all of the short positions, they can be like sort of anti-Google, such that your total portfolio composition is diversified right from day one before more diversified. But you're going to be able to work this thing down over time by getting, and also getting some risk mitigation in the near term.
Okay. Super interesting. And then I'm a bogglehead by nature, so like low fee index funds, and I've already accepted like adding some complexity through direct indexing. And then now this adds like additional complexity, and on top of that, having to have a point of view on the market. Like for me, that's where I get nervous. Oh, I'm adding margin to it. I'm adding like drift. I just want to be long the overall index, like the US market or whether that's international. Now I don't want to have a point of view. Like that's the antithesis of what I personally try to do. But at the same time, it's like an interesting piece where it's like, hey, if this is just a portion of my portfolio having some kind of tilt, maybe that's not a big deal in the grand scheme of things. And it's just one of those things like weighing the pros and cons there. So that's long short. Should we now go to exchange fund as another option? What is an exchange fund? How does that work?
So an exchange fund I don't want to say it's a misnomer, but the important thing is that it's a partnership corporate structure. And what that means is that I like the word partnership better than fund, because usually in a fund, you cannot contribute securities in kind. Now, I'm waving my hand here. I can think of some exceptions to that. But in general, the partnership structure allows anyone who's a partner to contribute securities in kind. And so the idea is that, Andre, if you've got Uber shares and I've got Amazon shares, then we can contribute those to the same pool of capital. And now, instead of having exposure to those individual names, we have exposure to the partnership interest as a whole. And so if a bunch of people are contributing their shares into an exchange fund, you can get diversified very quickly. And there are some strings attached to that, but does that concept make sense so far?
Yeah, for everyone else, when he's saying in kind, what that means is you don't have to sell your underlying assets. So in our scenario where we have $1 million of appreciated concentrated position, we're just not selling that and moving that entire position into the exchange fund, and in theory, getting instant diversification into whatever the exchange fund is targeting. Is that?
Yeah, exactly.
That sounds awesome. Instant diversification. I don't have to sell. Like, what? Sign me up. What are the cons? Like, it seems there's some asterisks coming. I could feel it.
Yeah, I won't even talk about cost, because I think the cost of these products has really come down. So I would say that used to be like a debilitating factor. Oh man, these things cost 150 basis points a year. No way. But that is just
I need $1 million to begin with to even go into it. And I think that's when like the recent trends, both on the direct indexing side, both on the long short side, and then now on the exchange fund side, like the democratization of access. At one, the fees are getting more reasonable, and then two, you can get them directly as a consumer.
Yeah, these things are a lot more easy to access. The position sizes are smaller. The costs are a lot lower. Yeah, I would say this is like an arrow in the quiver that everybody needs to be aware of. I think it's a very powerful strategy. And the reason, we've already kind of talked about this, but the reason is that you get diversified right away. And like that's super powerful, because like with a direct indexing strategy or with a long short strategy, these things take time to do in a tax neutral way. Of course, you can just sell right away and you can roll the proceeds into direct indexing or long short, but then you're dealing with this tax hang up. So an exchange fund is another strategy here that kind of achieves that goal, but also defers tax. I want to say indefinitely, that's technically true. But the important thing to note about an exchange fund is that you've got the 7-year hold period. And there's a technical reason for it. It has to do with what's called a disguised sale. But don't worry about that. The important thing is that your capital, once you contribute those shares, only with some emergency access exceptions, like in general, that capital is locked into that diversified asset. And that might be good, might be bad. It just depends on your particular liquidity needs now. So now, instead of focusing on risk, we're focused on cash. And it just depends what your needs are. I'll say one thing that's cool about the exchange fund, most people don't talk about this, is there's a possibility you could take those partnership interests and you could leverage them. So you could get additional liquidity out of the partnership interests themselves rather than having to worry about extracting value from the exchange fund. So you have flexibility. This is a buy, borrow, die strategy most people don't think about too often, but the exchange fund is not as inflexible as we think, as long as we're like willing to be a little creative with how we access capital out of it.
Okay, so it has additional fees versus some of the long short options, and then there's like the 7-year hold on the con side, but the pros being instant diversification.
Yep.
And you're mentioning you're able to borrow. There's some scenarios where you're able to borrow against this. Is it during that 7 years, or is it after the 7 years?
Oh, that's a good question. I don't have the answer to that off the top. Yeah,
Okay.
I just know that that's a valuable real world asset, and its risk is well known. That's why it makes it a marginable asset, but I would say not traditionally marginable. You can't put the partnership interest into a brokerage account and then lever it up. It would be more involved in that.
Okay. And then the ones that I've seen, it's been where like, hey, they have to want or they have to need your underlying stock. It's like, hey, this is an exchange fund that turns into the S&P 500 or the Nasdaq 100. So they're physically collecting. Oh, we need some more Uber, we need some more Amazon, and we're collecting all these concentrated positions from individuals and putting it together into this exchange fund. Adding in some real estate is my understanding, but generally it still tracks that underlying index, and then it will just getting whatever index it's trying to track. So in that case, it would be like, hey, S&P 500, awesome. That's similar to what I might be doing anyway. Nasdaq 100, it's a little bit more concentrated than me personally, but if someone wants to be more tech heavy, that could be a perfectly fine option of what they're going to do anyway. Is that anything to add on that?
Yeah, people are often surprised by the composition of the private assets. So the way that we get like this tax treatment, which is deferral, the way that we get it is we're going to contribute assets into this partnership. And then usually what happens, the typical implementation is the partnership takes those assets and they take out a margin loan for an additional gross up 20%. And then they invest that grossed up 20% into an illiquid asset. And that illiquid asset is what keeps the overall fund structure from having to recognize a capital gain and pass that through to investors. So you need these illiquid assets. It's actually funny. I was talking with this guy last week who was just like, could I contribute my marina into this thing as a private asset? And I was like, I don't know. I'll ask some friends. I don't know. I hadn't heard of that. But essentially, like the private composition of this portfolio that's a whole world. Some folks will buy like a REIT, for instance, like an illiquid REIT. Other folks like will structure the exchange fund and they will manage the individual properties that are part of the illiquid part of the portfolio. So it just depends on the manager. The only thing I would say if anybody's considering an exchange fund is just take a look at how the illiquid assets are managed, because it is a pretty decent chunk of the overall exposure.
Okay. And in this case too, like now I have 500. I still have my original cost basis, which maybe is fine. Like my goal was to get diversified. And then now I also have to hold it for 7 years before I can access it. So I need to make sure I don't need those funds within the 7 years. It sounds like maybe there's ways to get it, but it will be challenging.
It's a deviation from the path.
Yeah, 7 years. Yeah, 7 years, man. That's like the one. It feels different than everything else, where there's like the timeline, or I have control, or I can like get out of it. And what happens after 7 years? What am I left with?
So you'll get like typically a representative sample of the portfolio. So it depends on the composition of the portfolio. But one thing to clarify is that like oftentimes like folks will feel like, oh, I'm going to get all these illiquid assets when I redeem my shares after 7 years. That tends to not be the case. The shares are managed proportionally, and typically you don't end up getting illiquid assets. You'll just get individual stocks back.
Okay, awesome. Should we now go to? I've heard about CRUTs and charitable remainder trusts, and where does the U come in?
So the U is the unit trust. It's such a weird word, unit trust. It's one word, UNI trust. So it's a very weird word. I haven't seen it used anywhere else, but that doesn't matter. But the idea is that you just very quickly, you are going to contribute your concentrated stock position into the CRUT. And then what the CRUT is going to do, a couple different things, but the first thing is that it's going to give you an immediate charitable deduction. And the scale of that charitable deduction depends on the term of the CRUT. And the CRUT is usually like 10, 20 years, could be lifetime. But essentially what happens is that you take the present value of a bunch of payments that are going to come to you, and that deduction ends up getting applied this year. None of that matters. Those are details in just a second, but suffice to say 20 to 40% of the contributed assets, the fair market value, is typically deductible in the first year, 20 to 40%. Okay.
So in this case, like we have $1 million of concentrated position, we would move that $1 million in kind into this CRUT and then have 20% of that, so $200,000 as a charitable deduction in that calendar year. Is that how I think about that? And what value is that to me?
There's a couple different things. So first, like you did not sell the position. You have no capital gains realization event tied to this charitable contribution. The second thing is that this charitable deduction can offset ordinary income. So you have those two things. You skip the realizing
I
capital
say that
gains.
again. So I can use
Yep.
that $200,000 to offset income.
Yeah, totally. Yeah, it's an ordinary, I would put it on the same level as it's an itemized deduction, just like your mortgage interest expense. And so but I'll say that there's a caveat here, there's a cap on it, and the cap is 30% of your adjusted gross income. But just suffice it to say, this thing does not have unlimited applicability, but it does have quite a bit of utility for ordinary income. So
So
that's
it's an
just
active loss. That's okay. That's interesting.
yeah, not a loss, it's a retained asset, but yeah, exactly. You
Or
can
I'm trying to
apply it
translate into the this is one of those rare instances where you're able to offset actual
ordinary.
income.
Yeah,
But
ordinary.
okay.
Yeah. And
But
the
now
other
am I
thing is,
donating this away? Is it gone?
yeah. So this is a charitable remainder unit trust. And the trust part, this is an irrevocable trust. So once you give these assets away, they are gone. And there's a caveat here. We'll get into it. It's interesting. But once you donate those assets, they're gone. It's an irrevocable trust. And then what happens is that the trust is going to make payments to you over its tenor. And the payments are variable. So they change every single year. And then they are paid out to you depending on the character of the portfolio in the CRUT. So let's say that you start with the concentrated shares, you contribute them to the CRUT, you get the immediate deduction. But now what does the CRUT do? The CRUT is an independent entity. It files its own tax return, and it is also not taxable. So what happens is not taxable to the CRUT. It is taxable to you, you'll see. So you sell the shares inside of the CRUT, and then the CRUT has a pile of cash. All right. And that the CRUT has in its internal tracking has noted that those are long-term capital gains. And in the meantime, the CRUT is going to reinvest the proceeds from that sale. And let's say they just invest in a diversified portfolio. Okay, the S&P 500, whatever, Russell 3000, doesn't matter. It could be globally diversified, doesn't matter. The important thing is that CRUT is going to start making payments to you. And the payments to you are taxable to you as a person. And the character of those payments is passed through in a certain order in the CRUT. It starts with, I say it this way, it's worst first. And so you're going to get all the worst income first, all the highly taxed ordinary income. This matters if the CRUT invests in bonds. So if the CRUT, you dump all this money into a CRUT, the CRUT invests in a fixed income portfolio, it starts paying you ordinary income, you're going to receive all that ordinary income.
Do you choose what the CRUT invests in?
You personally cannot do it, but you can provide instructions. And there's two layers here. There's the trust and administration layer. You can have a corporate trustee, which handles administration, which would be accounting, annual tax return, payment distribution. That's the corporate trustee. And then you have an investment advisor who can have purview over the strategy. And this is also really interesting. A lot of people maybe don't know this, is that the investment advisor can be your investment advisor. So if you have this total portfolio, they can be oh, you need international exposure. We can use the CRUT for that. And so you can just take a holistic household wide view on CRUT investment. The important thing here is that the payments come out to you annually. This is a big deal. Those payments, again, are taxed to you. But what you've done is you've essentially taken this concentrated position and you've turned it into a variable rate bond. So does that make sense?
So I'm instantly diversifying.
Yeah.
I'm getting a charitable deduction up front, but I can't access all of it. Is it whatever terms I signed up for in the beginning I'm stuck with, and then I'm getting this income out of it. So I'm spreading out all of the income instead of having it realized all in 1 year. I'm now spreading it out over whatever term I sign up for a CRUT with a 10-year, 20-year, 30-year term up front. So there's some predictability in that, but the amount I imagine is variable based on how the underlying investments in the CRUT are performing.
Yeah, exactly. The portfolio in the CRUT is you are exposed to the income stream that portfolio in the CRUT generates. Okay. And you have some other levers to play with there, but the important thing is that once the CRUT reaches its terminus, so it could be 10-year, 20-year, lifetime, whatever. Once it reaches the end, it has to give a certain chunk of the residual, or the remaining, remaining is a different word from residual. It has to give a chunk of the remaining assets to a charity or multiple charities that you have specified. So that
Hence the remainder part of the remainder trust.
another interesting thing about a CRUT. So CRUT is a very flexible vehicle. There's tons of history behind this individual product. This is not necessarily a financial innovation. It's a thing that's been around for a very long time. It's codified in trust and estate law. This is a very old product. But so the flexibility that you get with a CRUT, so a lot of people will say, oh, this is for estate planning, things like that. The reason is that you get a lot of flexibility. So you, let's say Andre, you put all your shares into the CRUT and you can be like, no, my daughter gets all the payments. And like she didn't have a tax.
And do I have to define all of that up front? Like
You do. Yeah. All of that is pretty much defined up front. There's one hang up there. There's one, like there's an exit path if you need it. But in general, yeah, you set up all that stuff up front. There's some flexibility. So like you're going to define the beneficiaries. You're going to define the tenor of the trust, the investment mode, all of that stuff. And then also the charity that's going to get it at the end, the charity or charities. They can be a full list. It's unlimited. But a lot of folks like are just like, oh man, how do I know what charity I should have the remainder interest given to in 20 years? Like, how would you know that? So like some people will just take it and they'll put it into a donor advised fund at the end as a defined.
Oh, you can layer it into a donor advised fund at the end, so you still have control over where it goes.
You technically do not have control, but just like you don't have control over donor advised fund assets anyway, they're taking your recommendation. They are taking your recommendation. So they would take
an extra layer.
It's an extra layer.
Okay, so up front, let's say you're not confident about, okay, I'm not certain on where this is going to go.
Yep.
I'm going to up front say this is going to by default go into a donor advised fund, which I then can make recommendations to that. So I don't have to make all those decisions on which charity the end result goes to. Okay. So one thing I'm still a little confused on is, awesome, my $1 million, if concentrated position, is moved into there. How much am I getting next year? And what over the next, let's say I do a 20-year term, like how much am I getting of that? And like how much of that, like 1 million am I getting there? And like, how do I think about that versus all the other options we talked about? I'm confused on the income stream coming out of that.
Yeah, that's one of the things about the CRUT that's interesting is you're taking this concentrated position that is unmonetized and you are turning it into an income stream. And the income stream is variable. It changes every year. The IRS has a rate. It's called the 75/20 rate, and it varies over. I think they reset it every month. So it varies over time. This is calculated, and these payments come directly from the trust itself. And it's just like a cash distribution to you with a certain tax character attached to it. So again, like the primary concept is you've taken this asset, this chunky asset, you've turned it into an income stream, a variable income stream with defined tax character, but it changes over time as the portfolio composition bounces around. Do they have to sell assets to meet the payments? Is there a way to not distribute, to defer payment? You can using a thing called a NIM-CRUT, but that's a separate topic. But suffice it to say,
there's CRUTs on top of CRUTs. So give me a ballpark too. Like what am I talking about? Like how much of that original million is going to come back to me? If it's invested, is it going to be like more than that initial million? And like how much is typically left at the end for the charity? I'm trying to like put this into real numbers, and I still struggle a little bit with understanding.
So for the trust to actually maintain its status as a tax-exempt vehicle, it has to distribute greater than 10% at its tenor to a qualifying charity. So that's the important number to keep in mind, is that 10% remainder has to be contributed.
So my initial million, it needs to at least have $100,000 at the end.
Yes, exactly. Yeah. Or else it's going to fail. It's going to have some tax consequences attached to it.
What happens if it fails? Is it then I have to okay, it's a big mess. Don't fail.
Yeah, the trust has to pay tax. And right now the trust does not pay tax. It files an informational return, but it does not pay tax. But it would have to pay tax if it starts to violate trust doctrine. And but you can imagine this is a huge area of sort of administration. Like people get in trouble.
It seems like there's a lot of lawyers involved in this.
It is. So maybe that's one of the most important things to talk about with setting up a charitable remainder unit trust is unless you have a quite large situation, the annual expenses can be 1% to 2%. That's a ballpark. And again, you have trust administration, you have initial setup costs. That's a lawyer that you're talking to who's going to give you very specific documents. Again, you're going to define beneficiaries, you're going to define charities that this thing is going to pay into, that it's going to pay the remainder into. Then you have ongoing custody costs. Then you have ongoing administration costs. And then you also have investment management costs. So for instance, if I take the concentrated position, liquidate it in the CRUT, and then invest in an S&P 500 ETF, at the very least, I have the expense ratio of the ETF. But if I'm doing something more complicated, bespoke strategy, whatever, you can imagine those costs have two layers. One, there might be an investment manager who's overseeing the whole thing, processing trades, executing whatever, and two, the investment fee from the products themselves. So all in, unless you've got some kind of like special deal with a university, I highly recommend Harvard Law School has a calculator that you can use to figure out what the charitable deduction is going to be and like cost structure and all those things. Unless you have a pretty big situation, like the cost is going to be relatively high. So 1% to 2%, that's ballpark rule of thumb kind of thing.
So this is the most complex solution, maybe the higher fee solution, maybe the least like flexible over time. But then there's like I'm only saying the negatives.
Yeah.
I'm only talking about the negatives. I know there's like a ton of positives on it. My desire for simplicity is getting thrown out and trying to wrap my head around all of the layers.
The CRUT is like a very powerful strategy. The reason is that you can put anything in it. And so, like, we're talking about public market equities, but you could put a house in there. You could, you could put Bitcoin in there. Like, you could put partnership interests into a CRUT. So imagine like having your exchange fund contribution, and you're just like, oh, I want this to persist for the next generation. I'm going to take my partnership interest from my exchange fund contribution. I'm going to put them into a CRUT. You can imagine this stuff just gets like super complex, like really quick.
All right. So what we're going to do is I'm going to start off with a long short, and then at the end of the long short, I'm going to unwind that and still be left with a bunch of long positions that are super concentrated. I'm going to move all those concentrated positions now into an exchange fund to get me instant diversification. And then at the end of 7 years, I'm going to move that exchange fund into a CRUT.
No, it works. And it's like Russian dolls. Okay. It's Russian dolls, right? Yeah. I mean, like this thing just like, you can imagine just like unpacking this thing and you're just like, wait, these are just stocks, right? Should I have just paid the tax?
I could have just paid the tax and never had to deal with any of this and don't have to think about any of these pieces. So again, like all of the default should always start with let me just pay the tax and move on with my life. And then the complexity, the fees, the potential lockup periods, the access and control over time. So in the CRUT, are you able to like, oh, I want to buy a house. Can I take a loan against that? It seems, is there any flexibility there? Like at least like in the exchange fund, there's like an emergency hatchet. Is there anything possible in like the CRUT to get some money out?
So I can't say on taking a loan against it. I want to be like really careful about that because I don't know offhand. But I know that the CRUT has what's called residual interest, and the residual interest is an asset. It's an asset on your household balance sheet. And I'll say this, like not having firsthand experience with it, that there is an active, apparently secondary market for residual interest in CRUTs. And so you can imagine if you needed to get out of this thing, essentially what happens is you take the residual interest, you put it into another CRUT, and you've essentially restructured it for your current circumstances. So there are ways, is what I'll say.
So this is, like you said, it's like an old school product that's been around a long time. And again, like the other options we were talking about, it seems like recently there's been more direct to consumer options available. It seems like that isn't the case on the CRUT side. Are you aware of any or you need to go through an advisor, you go through lawyers, there's no self-service CRUT tool?
Yeah, and sometimes a charity will do that for you. So like at the Harvard Law School is a great example. I say the Harvard Law School because they have just a widget that they'll do a lot of the heavy lifting for you. But I guess the background on that is that maybe it doesn't have as much flexibility as if you had worked direct with an attorney. But yeah, that is a professional service product.
Okay. And then in our scenario, would that make sense? Like the $1 million, $700K within there, the rest is diversified. Like among these kind of, again, all not advice, all these things of like individual circumstances, like it's so much nuance and where all this stuff is so important to be able to weigh the pros and cons. But like at base value, given our scenario, would a CRUT be an interesting option in this scenario?
I could not say definitively. It just depends on the person's circumstances. Like another benefit of the CRUT is you get to define who it goes to. If you want to say, hey, 90% goes to my daughter and 10% goes to the dog shelter down the road as a defined contribution, whatever, you can do all those things with the CRUT. Yeah. It depends on your income.
And what happens if when my daughter inherits it? Is it like stepped up basis, all that usual stuff with the other assets?
Oh, so she doesn't inherit it. She's getting cash payments like in the interim. They're going into her pocket. So that's like literally a check that she receives and she can do with it what she wills, or what she wants.
Okay. So instead of me directly gifting my daughter cash over her life, I could move this concentrated position into the CRUT and then set up the rules of the CRUT to pay out directly there. Again, like, okay, so It is a
It's
so that
it's a
I turned my daughter into a trust fund child
you
through
will
this.
have accomplished that goal if that is what you want. And yeah, it's a CRUT can go all the way through your lifetime. It can there are some other levers you can pull, but it removes the assets from your estate. It's an irrevocable trust, so it accomplishes some estate type goals.
Okay, super interesting. All right, we got selling, we got long shorts, we got overall direct indexing, exchange funds, and then CRUT. Yeah, there's so many options, and we didn't even touch on all of them, right? Like there's like 351 exchanges and a ton of different things. Like if you haven't, like Brett has a fun book on 351 exchanges. If you really want to nerd out, it's all memes, and the best part of it is it's all like all of the art is what's it called, the
it's
like
Renaissance. It's so weird. I like it's one concept per page. I don't want to sell the book, but if you want to learn about 351, it's actually a good. We didn't have time to talk about it, but it's actually a good solution in this case.
Let's talk about it. I'm not going anywhere. What is the 351 exchange? We'll add in a bonus for the people that stuck around. There's another strategy that you could do after beyond the four that we covered called the 351 exchange. Brent, take it away. This is your wheelhouse.
We've got an extra arrow in the quiver if you have diversifying assets. So in your case, or the scenario that you gave me, Andre, we've got your other equity portfolio. We also have cash. You wouldn't employ the cash in this manner, but suffice it to say, your 10% concentrated position has got a lot of other diversifying assets attached to it. So what you could do is you could take a diversified portfolio. There's a very specific definition of that. Per IRS, it's no more than 25% in any one position. You could take that diversified, tax diversified portfolio, and you could contribute it to an ETF that is processing 351 contributions. And you have to, this is a one-time event. The ETF can only do it at launch. And there are some other provisions that you have to adhere to, but in general, concentrated position plus a diversified portfolio is a real strategy that folks should consider. It won't work if the portfolio gets way out of whack and you have 90% of your net worth is tied up in a single name. But in this case, where 10% of your net worth is tied up in a single name, a 351 is definitely an arrow in the quiver.
Super interesting. Okay, and then let me know if I understand, because like there's some like specific qualifications where, like the other options, I was just taking my concentrated position and like doing something with that. In this case, there's like a specific rule where my concentrated position, like any single position, cannot make up more than 25% of the amount that I'm contributing into the exchange, and then no more than 5 assets, something. So let me spell that out here. So in this case, if I did want to move that entire $1 million of concentrated position into a 351 exchange, I then need to bring along another $3 million to keep that single position under 25%. So maybe I have, again, my rest of my portfolio is super diversified. So I have VTI, VXUS, so all these different like super diversified ETFs. So I have 3 million of those diversified ETFs plus my $1 million of concentrated position, and magic 351 exchange into, then what happens at the end? What am I getting? What is it exchanging into? And what does that mean? What are the implications of all of that?
Okay, so what's going to happen is that your tax status before and after the conversion should be exactly the same. And so what that means is you'll take the concentrated position, $1 million, you'll add in 3, let's say a little bit more than 3 for a volatility reason we can talk about, but you're going to contribute this diversified portfolio into an ETF. And then the ETF, once you do this creation, it's literally a creation in the ETF sense. It's like an overloaded word. Where's my engineers? That's an overloaded word. It's a special word. So anyway, what's going to happen is in your brokerage account, what are you going to see? You're going to see a bunch of shares of that ETF. So all of your VTI, VO, whatever, all of that stuff is going to, and the concentrated position, all of that is going to disappear. And then once the conversion is complete, you're going to see a bunch of shares of the new ETF. This is what matters, is that if you double click into those shares, you're going to see a bunch of different tax lots. And the tax lots have 2 attributes that people should just be aware of. One, they have the cost basis. That's if they're RSUs, that's the vest price, or it's the acquisition price for an ETF, something like that. And then the other part,
the $300,000, the 25% of that has the $300,000 cost basis.
Yep.
From the concentrated position, plus the cost basis of the other $3 million that I put in, whatever the cost basis of those originally within there, right?
Yep. Exactly. And then so there's the cost basis and the holding period. So it's going to have the acquisition date. Again, my engineers out there, you're going to have this tuple that is embedded in each tax lot. The two important bits are the acquisition date and the cost basis. And so you're going to have a tax lot per those unique pairings. So there might be some grouping there, but in general, you're just going to get a bunch of tax lots for one ETF. And so what problems does this solve? So there's a couple different things. One, you will have over time, it takes a while to rebalance the portfolio, but in general, you will have achieved diversification without realizing tax. So if you had a concentrated position and you know that you were going to get diversified eventually, then 351 gives you like a smooth glide path from concentrated to diversified. Now, there's a hang up there. I'll just caveat this. The portfolio is going to go through this transition phase. It's going to receive a bunch of assets, wacky assets from all over the place. And then it's got to have a reason to rebalance. It can't accept a bunch of off thesis junk and then get rid of it all in one day using the magic of the ETF wrapper. It needs to go through this process of establishing substance over time. So typically what I see is you'll seed a portfolio in kind, and then over the next like 1 to 12 months, the portfolio will gradually migrate and reduce tracking error down to its prospectus thesis. That would be like best practice that I've seen.
So in an exchange fund, I'm like finding an S&P 500 exchange fund. So in the 351, am I finding, let me find a 351 or is it a 351 provider? I don't even know the terminology that is targeting an end diversification of the S&P 500. Is that kind of the same way? And I'm assuming that it's not only my assets. It's like a lot of other people are all contributing at the same time, similar to how the exchange fund would work. And then at the end, I'm getting this like brand new ETF that I can buy and or sell and trade like any other ETF in my account. It just has this like weird underlying mix of basis. It's
That's it.
confusing, but that's the crux of it?
That's it. Yeah. Yeah. You're going to get all those tax lots. And a lot of people bring this up. They'll say, what? Oh, it's an ETF sponsor. That's the like the kind of
ETF sponsor. Okay.
Yeah. That's the governing entity that oversees the management of the ETF. One point that's interesting is a lot of people ask me like, hey, what's the difference between a 351 and an exchange fund? Because you're right. We are pooling assets from a bunch of different investors and we're putting them into a new fund, a new investment vehicle. And that investment vehicle has a mandate, it has costs, all these things. What's the difference between a 351 and an exchange fund? And really the key difference is that an exchange fund is specifically concentrated positions, usually single stocks, into a diversified asset. It's making the transition from concentrated to diversified. That is not the case with a 351. 351 is diversified to diversified. And it's funny, the two sections of the code, 721 governs the exchange fund, 351 governs the section 351 conversion. These are like sisters in the tax code. They have very similar treatment, but they're just really important. Concentrated to diversified using 721 and the exchange fund, and diversified to diversified using 351 and the ETF wrapper. So totally different use cases. It has to do with the composition of the original portfolio.
Okay. So if I have a concentrated position only, I can't do this because one stock has to be max 25%. It sounds like you definitely want buffer there. What's the process? Because the exchange fund sounded like mostly instantaneous now, like within maybe a month or something like that. It seems the common. This one sounded like there's a lot more steps and consolidation and then like a timeline to eventually reach the target diversification. Like what's happening there? Walk me through that.
Yeah, this is one of the interesting elements of the 351. Just in the cases that I've examined, and I've spoken with a ton of fund sponsors and things, this seed portfolio composition could be just like all over the map. And like, for instance, one that I looked at last year, I think something like there were a couple chunky positions, 5% NVIDIA, things like that. But then a lot of it was other ETFs. We had fixed income ETFs and a Bitcoin ETF, whatever. A bunch of just junk, not junk, they're not bad assets, just other assets are going into the new ETF. This diverse portfolio is going in to meet the new prospectus requirements. And just getting from A to B, from seed composition into perfectly on thesis, the best practice there is to establish economic substance before every single transaction in the portfolio. And the way that you establish substance is by essentially saying there's a reason for this trade. This trade is not tax motivated. We're not just trying to avoid or taxation. We're trying to affect our view using this portfolio. And so I see this transition happening generally over time, 1 to 12 months. What does that mean for investors? It means that they've got tracking error. And the tracking error is the difference between the seed portfolio and the thesis that is defined in the prospectus. And the prospectus is a legally binding document. It says this is what you're going to get when you pay me an expense ratio for this ETF. And so the migration from diverse seed portfolio into on thesis usually just takes time.
Okay. So it's not as instantaneous, but once you're in the ETF, like you can sell, it's just like the tracking error might be higher until it gets to matching the thesis or whatever, which can take up to a year, it sounds like. What are the fees in this case, and like what are the minimums that we're talking about?
Yeah, okay, that's an interesting point too. There are two different elements here. So one on the fees. So definitely see higher cost ETFs seeded in kind. It really has to do with the
So I'm taking the underlying ETFs I'm giving also have their own fees, but now it's going away. Oh, because this is when we were talking about at lunch, one example that came up here was I have some like Fidelity mutual funds that I can only hold at Fidelity, like they're the zero funds, and they're in my taxable account. And I really wish I didn't put them there. So this could be an example. Oh no, I can't do it. That's the other caveat, right? This is a mutual fund. I can't move mutual funds in there. Only ETFs. There's I'm remembering the chapter in your book around not mutual funds. So that's a bad example there. But let's say I had a high fee ETF, then that could be part of that I'm moving over. But then I cut you off on the actual fees of what I'm getting at the end.
Yeah, in general, are the biggest launches that I've seen, the largest ETFs that are launching, or let's say, or like over the past year, I think I've observed 10 of them, 10 351s. The largest ones tend to have lower fees. And so that's part of their competitive offer. They're just like, look, we've got a new investment strategy. We're going to also save you some cash from an operational perspective. So that to some folks, that's really appealing. So cost can go down, it can also go up. And I say that all of this is precisely defined in the prospectus. And so you have total
ballpark me.
There was a large cap ETF that came to market a couple months ago. It was 15 basis points. But on the other end of the spectrum, I see a lot that are right down the middle, 50, 40, 50 basis points. And then I see some on the upper end too. And let's say 90 to over 100 basis points. And the reason is that they're doing something really specific for oftentimes a defined audience. You can imagine like a gigantic family office, which is just a rich family that has its own investment managers. Let's say they have $200 million, $300 million, and they just want to reap the benefits of the ETF wrapper, which is just a lot of tax deferral. Then they could contribute to an ETF in kind. And that fee might be higher. Depends on what the manager's doing for them. But usually that's pretty bespoke treatment. Using a public vehicle, it happens.
And then how does this fee compare to the other options that we talked about?
If you're broad-based, 351 is like a super competitive option. Just check out the fee in the prospectus. If it's 15, 20 basis points, that's probably...
That seems much because even like with the long short, we're talking about more than 1% at the lowest end, and then here you're saying at the high end you're starting to get to that 1% range. Is that like
when something really unusual happens? But for the most part, 15, 20 basis, let's say 15 to 25 basis points. Check it out in the prospectus, depending on the product you're considering. If the ETF looks good, there's a competent manager behind the scenes, and you can get some real operational efficiency there. You can get your costs down. And you can get some diversification benefit. Okay. You get indefinite tax deferral via the magic of the ETF wrapper. Yeah, it's a really powerful strategy in the right circumstances.
Snuck this golden goose at the end a little bit. It's like super interesting. But again, I think the important point here is it is going from a diversified set to another diversified set versus the other options we talked about are if you only are dealing with this concentrated position, what are the options for dealing with that? Like in the case of a 351, the concentrated position must make up less than 25% of the amount that you're giving it. Is it also true that within the 351, that is also true? So like at the individual level, it's true, and it's at the 351 level, it needs to be true, or how does that work?
Wait, rephrase maybe so I can follow.
So me personally, I need to make sure that my one concentrated position doesn't make up more than 25%. Does the ETF as well make sure, hey, I'm giving them a bunch of Uber, they need to make sure they're not getting a bunch more Uber that makes up more than 25% of the overall underlying ETF?
Yeah. So the specific provision says that if individuals are technically diversified, so if every individual contributor to the ETF is less than 25%, then that is considered a diversified contribution. And also mathematically, this makes sense. Like if I contribute 25% of my portfolio of
Okay, so if
Uber,
everyone, let's say everyone worked at NVIDIA and everyone contributed 25% NVIDIA, the end
Yep.
result is 25% NVIDIA max. Okay, that makes
Exactly.
the maths there. Okay.
Yeah, it does. It's a funny circumstance, but that diversification provision is ultimately like what sets it apart. And there's just like this clarifying thing. I just want to be really clear. When people talk about, oh, you can diversify concentrated position using 351, I tell you that makes me cringe. I'm just like, oh no, like we have.
You need to bring along another 75% of that like the amount of the concentrated position. I guess not 75%, but like 75% of whatever you're putting in needs to be diversified.
Exactly. Yeah. And so you cannot do this like baldly. You need to have a diversifying portfolio. It needs to be tax diversified, and tax diversified, the diversification rules. It's the 25/50 rules we've already talked about.
And in this case, so we said, okay, like there are now direct consumer options for long shorts. There are now direct consumer options for exchange funds. There's not as much direct consumer options for the CRUT, maybe going directly to the charity. In the case of the 351, are there direct to consumer options, or is this one that needs to go through an advisor?
It's typically an advisor, and the minimums there, that's right. The minimum there tends to be like $1 million in contributed assets, plus or minus. Talk this, and then my suggestion there on that one is if you're an individual and you're considering a 351, talk to the ETF sponsor directly. They oftentimes will pick up the phone. Like this is surprising to many folks, but you can just call them. And they are trying to grow assets too. It's conducive to their business. It's a mutual win here. Yeah, call them and talk to them. Hey, I've only got 500,000. Can I do this? They might service you directly. So that's the first thing. They might. And the second is usually they have partners who will do this as a one-off kind of transaction. Yeah. So
that's actually an interesting case. So like you're saying, oh, it's $1 million, and it sounds like, oh, that's a lot. But you're talking about $1 million overall. So your concentrated position can only make up $250,000. So let's say that you have a $250,000 concentrated position that has a super low basis, and the rest of your portfolio is diversified, and so you can, that $1 million all of a sudden, it's like not only in one position, it's like across your taxable portfolio. That amount, it gets much more reasonable. And the fees are much smaller than I thought they would be, because again, I'm moving over ETFs that already have fees, like even VTI, like 0.09 or whatever. Yes, I double that, but it's not as ridiculous as I would have assumed. It sounds complicated. It sounds like, oh, I'm making my own ETF and all these other things, but that's super interesting. How come people don't talk about 351s as much?
So we're just like constrained by the number of products coming down the pipeline, because you can only do this at launch. So like a new ETF has to launch, and like just how
okay, so it's not like exchange funds are now like, hey, there's like rolling exchange fund offerings. I can do long short at any time. Okay, there's 4 months left in the year. I have this $1 million Uber position. Let's say I am willing to move $3 million out of my taxable portfolio as well. Is it possible to do this year?
Yeah. We would have to find one that's coming to market, and I'll just say that the pipeline is sparse. 1 or 2 a quarter, maybe 1, 2, or 3 a quarter. This is definitely not a mainstream thing. So I have not seen any large, gigantic ETF sponsor roll this out as like a standard operating procedure. So, BlackRock, Vanguard, State Street, any of these guys, none of them have decided, oh, I'm going to start doing 351s, and it's going to be a means for me to attract new assets. No, none of them. So we're seeing a bunch of.
Is it just pretty niche?
Yeah, it's niche. I think it's compelling. I think everybody should do it, but they are introducing operational risk by screwing this thing up. And there are some technical reasons why it would just be a pain for them. And they're just like, whatever, we're big. If we launch a new ETF, what is it, $50 million? Who cares? I manage $2 trillion. But the smaller sponsors who are like, oh, I manage $1 billion. And if I launch an ETF and it gets me another 200 million, 300 million, then yeah, for sure. We have good affinity here. There's a good opportunity for investors who are like looking for solutions with providers who've been around for a while, but just don't have just gigantic scale.
All right. And then last couple questions. Where is this ETF can be held anywhere? Like I can have it in my Vanguard account, Fidelity account, Schwab account.
Usually, yeah. Sometimes the sponsor will say, oh, well, they only work with Fidelity and Schwab as a landing place, maybe Interactive Brokers, things like that. But it depends on the sponsor. So I'll tell you that what I've seen people have to do is they'll recustody their assets into a defined broker, Schwab, Fidelity, et cetera. Then the 351 will happen, and then they'll recustody over back to where they were before.
When I sell, I have a very complicated mix of different tax states. How is that? Is it all going to be in my 1099 consolidated? It doesn't seem as straightforward if I just like, hey, I moved it out of whatever it was, where it was custodied into my own, into like my Fidelity account. Is it as simple as that, or is it like much more complicated and it's going to be mixed when I'm selling it? Like, how does that work?
Yeah, so that's a good question. So ideally, you're not producing any taxable events. So in the ideal circumstance, you will not get any 1099. hooray, there's nothing to report.
When I go to sell at the, like I have the underlying ETF shares
Right.
and then I sell the ETF shares, and you said it's originally going to be composed of whatever makeup you have of like
Yep.
all the different cost basis and this and that. Is it like at the end it's all blended together and like you have a single cost basis, a single amount of capital gains embedded, or?
No, you've got all the tax lots, just like you had your concentrated position. If you've got RSUs at your big company, you've got all the different tax lots based on when they vested and things like that.
Okay, so each individual ETF share, there'll be the ETF shares themselves will contain these. So when it's moved over to my other brokerage account, it will just look like I can choose which lots within there also to sell in the same way.
100%. So exactly, you want to get that dialed in for the minimal tax consequences when you're deciding the order that you sell these things for whatever reason. You need to make a down payment on your home or whatever. Sell the high basis lots first. Assuming they're all long-term, sell the high basis lots first, and then work down the stack as the tax consequences get more punitive.
All right. Well, this turned into a 351 exchange 101. That's super interesting. There's a lot of options. I think that's the key thing of this thing is like when you do have a concentrated position, like it's the default should be understanding like what is the tax consequences of just selling and being done with it. And then from there, being able to explore some of these more complex options. We still only touched a few of them, but they all have various pros and cons and restrictions and amount limits that you need to have, and like bringing in other assets to diversify, the amount of control that you have, the timeline from when you get that full control, or maybe in the case of a CRUT, you never have full control at the end. There's just a lot of options out there and different flavors of complexity. It's a fascinating world. And I think, again, it's fun to talk about all these ones, but going back to the simple, boring, sell, pay your taxes, move on. Just don't forget that's like the default stage. Start there and then start exploring the more nuanced approaches that might be applicable in your case, and definitely a good case of talking with a qualified professional that's very familiar with your unique circumstances and the entire picture of your entire portfolio, all of that jazz.
And not us.
Not us. Not advice. Not us.
Yeah, I appreciate you humoring me. These are like my nerdy interests. Thank you for all your questions. And yeah, this is a thorny problem. So concentrated stocks, like this goes back decades, and as long as public stock has existed, there's always been concentration. And the solutions are getting more and more creative. And they all have trade-offs, like you said, liquidity cost, whatever, timeline to diversification, all these different things. And just do your research, hire a professional if you need to. Again, not us, but we sure do talking about this stuff.
Yeah. Awesome. All right. That is episode 4 of the Not Advice podcast. I think that was one of the best ones yet.
Thanks for humoring me, Andre. I'll talk to you soon.